Welcome to the deep dive. Today, we're really getting into CrowdStrike's latest annual report. That's their Form 10K for the fiscal year ending January 31st, 2025.
Yeah, these things can be pretty dense, right? Lots of pages.
Exactly. So forget trying to wade through it all yourself. We're pulling out the key insight that you need to, really understand where this cybersecurity company stands.
Our mission basically is to give you a clear picture of what's CrowdStrike doing now, where they headed, all based straight on what they're reporting.
We've looked at everything from, how their business is structured, the tech they use, all the way to the financials and how they think about shareholder value.
Think of us as your guides, cutting through the complexity.
All right, let's start with the basics. What exactly does CrowdStrike do? Their main thing seems to be this Falcon platform. What's the deal there?
Right, the Falcon platform, it's their core offering a cloud-native security platform, so delivered entirely from the cloud, not installed on-premise like older stuff.
Cloud native, okay.
And what makes it tick, they say, is this underlying architecture called the security cloud. It's powered by these three interconnected graph technologies. You've got threat graph, intel graph, and asset graph.
Graphs, okay, tell me more.
Yeah, the idea, and this is pretty neat, is efficiency. They collect security data just once, but then they could reuse that same data across all these different analysis engines, the graphs.
Collect once, use many times.
Exactly. And they argue this interconnectedness creates a kind of network effect. More data makes the whole system smarter at spotting threats, something those older siloed solutions really struggle with.
So what do these different graphs actually focus on? Threat graph.
Threat graph is it's the AI and behavioral analysis engine. It looks at just trillions of security events, apparently, trying to spot malicious activity in real time. It's also enriched with lots of threat intelligence.
Okay, and intel graph.
Intel graph is more about the attackers, who they are, how they operate their tools. So it helps customers figure out, who might be targeting them and how best to defend against those specific threats.
And asset graph rounds it out.
Yeah, asset graph gives you that dynamic picture of everything inside your digital environment. Devices, users, apps, cloud stuff. Basically a map of where potential weak spots might be.
So this is really positioned as a replacement for older ways of doing cybersecurity.
Definitely. The report spends quite a bit of time highlighting the downsides of what they call legacy solutions.
Yeah.
The ones installed on site, often working in isolation, maybe needing multiple software agents that could slow down your computer.
Right, the agent fatigue thing.
Exactly. CrowdStrike's pitch is that their cloud approach is just more flexible, less intrusive, and ultimately more effective because of that unified data model.
And innovation seems key here. They've talked about R&D.
Oh, absolutely.
Okay,
They stress their ongoing investment in research and development. They've got an internal team constantly working on staying ahead of new threats, developing new modules, new features for Falcon. They also mentioned listening to customers and partners for ideas.
Makes sense. Now, cybersecurity is, well, it's a very busy market. Who are they actually competing against?
Yeah, they list a few main groups. Other cloud security platform vendors, naturally. And you have specialists, like identity security companies, professional services firms that offer security consulting, and even those legacy SIEM vendors.
SIEM, Security Information and Event Management, the log collector?
Right. The more traditional systems, CrowdStrike obviously thinks they have advantages: that unified platform, better threat detection, how well it integrates, how fast customers see value, their brand, support, all those things.
And protecting their own tech, patents and things.
Yep, that's part of the strategy, building up their patent portfolio. But they also, acknowledge the flip side, the risk of getting sued for infringing someone else's patents. It's just a reality in this space, unfortunately. Can be costly.
Okay, shifting a bit, what about the company culture, their values?
They highlight being mission-driven. They list these core values: one team, one fight, being fanatical about the customer, a relentless focus on innovation, and limitless passion, kind of typical corporate values, but they put them out there.
And they mentioned their workforce being distributed.
Yeah, they frame that as a deliberate strategy. Helps them tap into talent anywhere in the world, potentially fostering more innovation by having diverse perspectives, not just concentrated in one HQ.
And the leadership. Who's running the show?
The report calls out George Kurtz, he's a co-founder and the CEO, Bert Podbier, the CFO, and Michael Santonis, who's the president. It briefly notes they all have deep roots in the cybersecurity industry.
Okay, now every business has risks. What are the big ones? CrowdStrike flags in this report.
Well, there's a decent list. Relying on key people, like Kurtz, is one. Just the general challenge of finding and keeping top tech talent. The fact their operating results might fluctuate, protecting their brand reputation is huge, obviously.
Especially in security.
Exactly. Then there's the IP stuff we mentioned, potential lawsuits, and staying on top of all the different data privacy rules around the world. GDPR, CCPA, all that.
Now, the report goes into detail about something called the July 19 incident. What happened there?
All right, that was a significant event for them. Basically, they pushed out a content configuration update, not new software code, but a data file update for their Falcon sensor. And unfortunately, it caused widespread crashes on Windows systems for affected customers.
Ouch, that sounds bad.
It was. It led to lawsuits, both from shareholders and customers. Government bodies started asking questions. Financially, it meant big legal bills, professional fees, potentially slower sales as customers paused, and needing to offer compensation packages or credits to those affected.
And lingering effects.
They acknowledge there's an ongoing risk. It could impact customer churn. Some customers might decide to leave. It definitely seems to have impacted their sales cycles, as we'll probably touch on later.
So, a major headache. What other potential bumps in the road do they mention?
Well, the constant need to win new customers is always there. They face hurdles like customers being locked into existing systems or maybe economic uncertainty causing businesses to cut back on security spending. There's also the inherent risk. What if their solution misses something or has a bug? That could be devastating for their reputation. And being a security company makes them a prime target for sophisticated cyber attacks themselves.
Right, the irony.
Yeah. Then there are operational challenges, like scaling their sales force effectively, especially overseas. They note seasonality in their business orders tend to be higher in the second half of the year.
Okay.
International expansion itself brings risks, different regulations, currency swings, managing partners. About a third of their revenue, 32% last fiscal year, came from outside the U.S. Selling to governments also has its own dynamics. Policy changes, budget shifts.
Anything else?
Credit risk, customers potentially not paying. Managing their existing debt, they have about $750 million outstanding, making sure their internal financial controls are solid. And, the potential challenges if they decide to buy other companies and integrate them, acquisitions can be tricky.
That's a comprehensive look at the business side and the risks. Let's switch gears to the financials. Revenue growth looks pretty strong on the surface.
It really does. For the fiscal year ending Jan 31, 2025, total revenue hit just shy of $4 billion. $3,953.6 million, to be precise.
Wow. And compared to previous years?
Big jumps. It was about $3.1 billion the year before FY24 and $2.2 billion the year before that, FY23. So strong upward trend.
And most of that is subscription revenue.
The vast majority, $3,761.5 million in fiscal 25. That's up from about $2.9 billion in 24. And they say that's driven by, adding customers, covering more devices or endpoints per customer, and customers buying more of their different security modules.
Okay. And that revenue gets recognized over the contract term.
Right. It's recognized ratably, evenly spread out over the typical 1 to 3 year contract period. So the cash might come in up front, but the revenue hits the income statement gradually.
What about the other slice, professional services?
Much smaller, $192.1 million in fiscal 25, up slightly from $185 million the year before. This is stuff like incident response help, proactive security checkups.
You mentioned deferred revenue earlier. How big a factor is that?
Yeah, it's significant. They mentioned the $2,251.3 million of the revenue they reported in fiscal 25 actually came from their beginning deferred revenue balance. That's money collected in prior periods for services yet to be delivered.
So it's like a built-in backlog.
Exactly. It gives you visibility into future recognized revenue. Their total deferred revenue at the end of fiscal 25 was $3.7 billion. That's a big number.
Okay, let's talk profitability. Gross profit, gross margin.
Yeah, so gross profit depends on things like new customer additions, renewals, naturally, but also the costs of running their cloud infrastructure, expanding support, and just general efficiency gains.
And the trend.
They expect the gross margin percentage to sort of modestly increase over the long term as they scale, but they caution it could fluctuate period to period based on those factors.
What about operating expenses? Seems like those went up quite a bit, too.
They did. Total operating expenses increased significantly in fiscal 25. The biggest single piece, unsurprisingly, is employee costs, salaries, benefits, stock compensation.
Makes sense. And the different categories, sales and marketing.
Expected to keep increasing in dollar terms as they push for growth. But the goal is for it to decrease slowly as a percentage of revenue over time. Though, again, they say it might bounce around. This also includes amortizing the costs of acquiring those contracts in the first place.
R&D.
Still a major investment area. They're spending substantially to enhance a platform, add new capabilities.
And G&A, general and administrative.
That jumped up quite a bit in fiscal 25. And they specifically mentioned costs related to that July 19 incident contributing to that increase alongside general growth.
Right, those legal and professional fees. Okay. Income taxes. That saw a big jump, too.
Yeah, $71.1 million provision in fiscal 25, up from $32.2 million. They attribute this mainly to some intercompany intellectual property sales, earnings in foreign countries, taxes withheld abroad, and some changes related to the usability of deferred tax assets in certain places. Tax stuff gets complicated fast.
Definitely. Okay, let's look at their overall financial health, cash position, liquidity.
They seem very solid here. They ended the fiscal year with $4.3 billion in cash and cash equivalents. Plus, they have access to a $750 million revolving credit facility, which matures in early 2026.
So enough cash for the near term.
They state they expect the cash from operations plus that credit line should be sufficient to meet their needs for at least the next 12 months.
But they still have an accumulated deficit.
Yes, $1.1 billion as of Jan 31, 2025. That reflects their history of investing heavily for growth, often spending more than they earned in the past. They expect to continue investing, so that deficit might persist for a while, even if they're profitable now on, say, an operating basis.
Then that large deferred revenue balance helps too.
Absolutely. That $3.7 billion represents future revenue they've already secured contracts for, which provides a lot of stability and visibility.
Let's dig into cash flows. Where did the cash actually come from and go in fiscal 25? Operating activities.
That was strongly positive. Net cash provided by operating activities was $851.5 million. Remember, this starts with their net loss, but adds back non-cash expenses like depreciation, amortization, and particularly stock-based compensation, plus changes in working capital.
Okay, so operations are generating good cash. Financing activities.
That also provided cash, about $107.2 million, mostly from employees buying stock through the ESPP and exercising stock options.
And investing activities, buying assets.
Investing activities use cash, mainly for capital expenditures, buying property and equipment, likely servers and infrastructure. That was $138.2 million.
So overall cash position.
It increased significantly. Net increase in cash and equivalents for the year was $947.1 million. A healthy jump.
The report highlights some key metrics. Anything particularly noteworthy?
The dollar-based net retention rate, or DBNRR, is always a big one for SaaS companies. It was 112% as of Jan 31, 2025.
And how does that compare?
It's down a bit from 119% the previous year. This metric tracks how much existing customers are spending compared to the year before, including upsells, renewals, but also downgrades and churn. It excludes professional services.
And did the July 19 incident affect this?
It indicated it did.
Oh.
It caused delays in closing deals, lengthened sales cycles, which would negatively impact this expansion metric.
Okay. Can you give us a quick snapshot of the balance sheet at the end of the year?
Sure. Total assets, $8.7 billion.
Yeah.
Within that, the $4.3 billion in cash we mentioned. On the other side, total current liabilities were $3.5 billion. Long-term debt was $744 million. That big deferred revenue number, again, $3.7 billion. And total stockholders' equity stood at $3.3 billion.
They mentioned remaining performance obligations, RPO.
Right. That's the total contracted future revenue that hasn't been recognized yet. It was $6.5 billion at year-end. And they expect to recognize about 53% of that, so over $3.4 billion, within the next 12 months. Another indicator of future revenue visibility.
Okay, one last financial point. Free cash flow. They don't explicitly state it, but can we figure it out?
Yeah, we can calculate it easily. You take the net cash from operating activities, $851.5 million, and subtract capital expenditures, $138.2 million.
Which gives you?
$713.3 million for fiscal year 2025. That's a pretty healthy free cash flow number, representing the cash generated after accounting for the investments needed to maintain and grow the business.
Okay, so solid financials overall, despite some headwinds. Now, how are they planning to return value to shareholders? Are dividends on the table?
The report is crystal clear here. No. Crowdstrike has never paid cash dividends, and they state their current plan is to keep all funds to reinvest back into the business for growth, R&D, operations.
Any other restrictions?
Yes. Their credit facility also restricts their ability to pay dividends right now. So the bottom line is don't expect dividends anytime soon. Any future decision would be up to the board and depend on many factors.
All right, no dividends. What about share buybacks? Are they planning to repurchase stock?
The report doesn't actually mention any current plans for share buybacks. so that doesn't seem to be part of their current strategy for returning capital.
But they are issuing stock.
Yes, in specific situations. They mentioned issuing about $22.8 million worth of stock to help pay for the acquisition of Adaptive Shield back in November 2024. And, importantly, they issue quite a bit of stock through employee compensation programs.
Like stock options and grants.
Exactly. Employee Stock Purchase Plan, ESPP,
Yeah.
Restricted Stock Units, RSUs, Performance Stock Units, PSUs. This is a standard practice in tech to attract and retain talent. But you have to remember that issuing new shares can dilute the ownership percentage of existing shareholders over time.
And that stock-based compensation is a big expense item, right? We saw that in the operating expenses.
It really is. For fiscal 2025, the expense recognized was $865.4 million. That's a substantial non-cash charge hitting the income statement. They detail the different types of awards and their vesting conditions.
Do they have a lot more of that expense baked in for the future?
They mention having about $72.2 million in unrecognized stock-based compensation expense just related to unvested performance awards, PSUs, as of the end of the fiscal year. That amount will be recognized as an expense in future periods as those awards vest.
Okay, so putting it all together, the business strategy, the risks like the July 19 incident, the financial performance, the approach to shareholder value. What's your overall take on CrowdStrike looking forward, based on this report?
Well, look, the July 19 incident clearly casts a shadow. They acknowledge its impact on sales cycles, customer relations, and costs, and that's something you definitely have to watch. It introduces uncertainty.
Oh.
But the underlying engine, that subscription revenue growth, is still incredibly strong. It shows there's huge demand for what they offer in cloud security, and their financial position, particularly that large cash balance, gives them a lot of flexibility and resilience.
So a mix of challenges and strengths.
Exactly. You have to weigh the ongoing impact of that incident and the intense competition against the strong market demand and their solid financial footing. The risks they outlined are real market shifts, cyber threats hitting them, economic downturns impacting security budgets.
So future success depends on.
Continued innovation is critical. They have to stay ahead technologically. And effective sales execution, navigating those longer cycles potentially caused by the incident, expanding internationally, winning those competitive deals. It really boils down to execution and managing those risks effectively.
So based purely on this 10K, it seems like a company with really strong growth fundamentals, but one that's currently working through a significant operational challenge in a very dynamic market.
That sums it up pretty well, I think.
Okay, so to wrap up our deep dive into CrowdStrike's annual report, we've looked at their core business, the Falcon platform, the financials showing strong growth, but also rising costs and the impact of that July incident, and their plans, or lack thereof, for direct capital returns like dividends.
We've seen the strong subscription engine, the healthy cash flow, but also the risks and the competitive pressures they face.
Right. So considering all that, here's maybe a final question for you, the listener, to think about. Looking at CrowdStrike today, what do you see as their biggest single opportunity? And conversely, what's the biggest threat that could derail them as this whole cybersecurity landscape keeps changing so fast?
Yeah, how do they balance pushing the innovation envelope with managing those risks we talked about, all while trying to keep shareholders happy? It's a tough balancing act.
Definitely something to ponder. We hope this deep dive has given you a clearer understanding of CrowdStrike's position without you having to read hundreds of pages. As always, the source itself has even more detail if you're inclined.
Thanks for joining us.
Thanks for tuning into the deep dive.